1. Chevron completes Hess acquisition over Guyana oil dispute. A win for industry and investors. 2. ExxonMobil's arbitration loss in Guyana. What it means for oil and energy. 1. Chevron completes Hess acquisition over Guyana oil dispute. A win for industry and investors. The oil industry just witnessed a corporate showdown with billion-dollar consequences. Chevron has finalized its $53 billion acquisition of Hess Corporation after winning a contentious arbitration battle against ExxonMobil over Guyana's prized offshore oil assets. But here's where it gets controversial. This landmark ruling by the International Chamber of Commerce didn't just settle a corporate dispute, it set a precedent that's already sparking fierce debate across the energy sector. Chevron CEO Mike Wirth celebrated the decision during a CNBC interview, calling it a straightforward interpretation of contract language that benefits both Chevron and the industry. He emphasized how the ruling affirms that asset-level rights of refusal don't apply in corporate mergers and acquisitions, a position Exxon strongly disputes despite accepting the arbitration outcome. Just hours before the official announcement, Exxon CEO Darren Woods had revealed the unfavorable result to CNBC, setting the stage for a tense market reaction. Investors responded with clear skepticism. Chevron shares dipped nearly 1% during Friday trading despite early gains, while Exxon stock tumbled almost 3%. This market hesitation reflects the high stakes involved. The deal would have collapsed entirely had Exxon prevailed in claiming a right of first refusal over Hess's 30% stake in Guyana's Stabroek Block. That oil-rich region represents one of the world's most valuable energy plays, with Exxon controlling 45% and China's CNOOC holding 25%. Now for the human cost. Chevron's acquisition comes with planned job reductions despite Exxon's public welcome of Chevron into the Guyana venture. Wirth confirmed some headcount reductions are inevitable due to organizational overlaps, extending Chevron's existing cost-cutting strategy. This merger raises tough questions. When corporations clash over resources worth billions, who really wins? The companies gaining assets or the workers facing consolidation fallout? Share your perspective below. Do such rulings foster fair competition or merely concentrate power among energy giants? 2. ExxonMobil's arbitration loss in Guyana. What it means for oil and energy. In a bold move that has captured the attention of the energy sector, ExxonMobil Corporation has issued a statement in response to a recent ruling from the International Chamber of Commerce, ICC, tribunal regarding its contractual disagreements with Hess Corporation concerning interests in the Stabroek Block, located offshore Guyana. This ruling has significant implications for the industry, and here's where it gets controversial. ExxonMobil expressed its disagreement with the ICC panel's interpretation of the situation, yet it emphasized its respect for the arbitration and dispute resolution process. The company reiterated its commitment, alongside CNOOC, to uphold the integrity of contract terms, highlighting the importance of not setting a negative precedent for both itself and the broader industry. This stance raises an intriguing question. How far should companies go to protect their contractual rights, especially in a rapidly evolving market? The statement further elaborated on the substantial value that ExxonMobil has generated through the development of resources in Guyana. The company believes it has a clear obligation to its investors to consider its preemption rights, which are crucial for safeguarding the value created through innovation and diligent effort, especially at a time when the potential success of this venture was uncertain. In a welcoming tone, ExxonMobil also expressed enthusiasm for Chevron's involvement in the venture, looking forward to continued exceptional performance and value creation in Guyana for all stakeholders. This collaboration could potentially reshape the dynamics of the industry, but it also invites scrutiny. Will this partnership lead to greater innovation, or could it create new challenges? About ExxonMobil. ExxonMobil stands as one of the largest publicly traded international energy and petrochemical companies, dedicated to developing solutions that enhance quality of life and address the changing needs of society. The corporation operates primarily in three sectors: upstream, product solutions, and low-carbon solutions, providing essential products that support modern living, including energy, chemicals, lubricants, and technologies aimed at reducing emissions. With an industry-leading portfolio of resources, ExxonMobil ranks among the largest integrated fuels, lubricants, and chemical companies globally. Notably, It manages the largest CO2 pipeline network in the United States. In 2021, the company unveiled ambitious plans to reduce greenhouse gas emissions by 2030, targeting a 20 to 30% reduction in corporate-wide greenhouse gas intensity compared to 2016 levels. Specific goals include a 40 to 50% reduction in upstream operations greenhouse gas intensity, a 70 to 80% decrease in corporate-wide methane intensity, and a 60 to 70% reduction in flaring intensity. For more information, visit ExxonMobil.com and explore ExxonMobil's Advancing Climate Solutions initiative. As we reflect on these developments, what are your thoughts? Do you agree with ExxonMobil's approach to protecting its contractual rights? Or do you believe there should be a different strategy in play? Join the conversation in the comments.